So I welcome Marty von Felsen from Atradius. Hello. Patrice Lusson, COFAS, Paris. Jacob Hansen, Guy Carpenter, Marsh. And finally, Richard Wolf from ICESA. So happy to have you here in this conference. So 30 years ago, export credit insurers were at the very forefront of technological innovation and bringing online connections to exporters before the world internet was in common usage. So we are really curious about the views, how technology is transforming your business. So I would like to hand over now to my colleague.
Thank you, Robert. So yes, three of us on this panel actually 30 years ago were working in the same company. That's Marty and Richard and myself. And of course, we were all much younger in those days, I'm sure. But I do remember the day when somebody explained to me that there was a way to connect a computer in the customer's office to our computer and that they would be able to apply for credit limits online. And I was absolutely staggered by this because I do believe that at that time we were not familiar with the word internet. And I remember I said, how can it be done? And I remember somebody saying to me, well, there's this thing, Mike, and it's called the modem. And we use this to make the connection. And it was a strange new world for us. But amazing, really, the foresight of our forefathers in credit insurance 30 years ago to actually invent the internet before the word existed. So really, this is the question, can we still be at the forefront of technology today? And I've got a very distinguished panel here to discuss the topic with me. So first of all, I would like each of you to introduce yourselves. So let's start off with Marty, please.
Hi, everyone. My name is Marty van Velsen. I work for Atradius. I'm the director of Global there. Global is the unit where our multinational customers find their home. I was one of those colleagues, by the way, that my colleague was referring to.
Thank you. And so, Patrice?
I'm Patrice Lusson. Hello. I'm in charge of marketing and innovation at COFAS HQ in Paris.
Thank you.
I was not part of the colleagues of the time.
And Jacob, now you have been a colleague of all of us, I think, but not 30 years ago already.
No, I was just going to comment. I'm a little bit younger than you, Mike. I'm Jakob Hansen. I'm a managing director at Guy Carpenter, responsible for placing reinsurance for credit insurers around the globe.
Excellent, thank you. And Richard, finally.
Well, thank you, Mike, and thank you, Schumann, for the invitation. I'm the third of the three colleagues, actually, and I am allowed to lead ICESA, the International Credit Insurance and Surety Association, since June of this year. So I'm the novice at credit insurance and surety.
Thank you. All right, then, so let's get started on our discussion. And so the first thing I'm interested to know, really, is how your organizations are utilizing new techniques like artificial intelligence, machine learning, or the exploitation of social media. And maybe we'll start off with Marty.
Okay, yeah, we are using it, but also as 30 years ago, it's always using technology for the benefit of what our customers and our own organization. So what we're doing is sourcing a lot of data, which is exceptionally important, extremely important for most companies, actually, and see what the relevance of correlations is for the outcome of the predictions on how creditworthy companies are. So it has been quite a journey because the relevance is actually where the key lies. Sucking in data, excuse my language, is easy these days. But to then do something with it and actually transform it into, put it into models that see correlations, etc., and to give an outcome around cover and predicted defaults is actually the biggest challenge. We've taken steps, baby steps initially, walk before we can run, but by now we are taking in quite a bit of data. We do machine reading, so basically all the annual reports that we are looking at are being read by a machine. We basically, our underwriters have given the relevance to certain topics, and it's constantly being checked. Same goes for social media data, although that's often very much a sentiment issue. How relevant is it? But news articles, but also here, how relevant is it? And for instance, a product recall for a large company may not be so relevant for us to at least to put into a value and to see how much of an impact it has. For a smaller company, it has an impact. So it is being used, but the human part should not be forgotten, because there is where the judgment is about how relevant is the data that we are actually getting into the door. The good news is that on the smaller credit limits, we do see that the acceptance rate, so how much cover we can give versus the claims that they will generate, is actually a good one. So more cover and less claims. But as said, it's being constantly monitored still by humans.
Okay, well, that's a very impressive result, more cover and less claims. But it's really good to see you taking baby steps and it's actually happening now. So thank you, Marty. So Patrice, you were telling me that in COFAS you've had some interesting experience with the use of artificial intelligence, and sometimes you had positive experiences and also not so positive, which I thought was really fascinating. So do you want to share with us all those experiences?
Yeah, sure. So we use machine learning, let's call it like that, in different levels, including at the very core of the system, which is risk underwriting, risk analysis. So we have what we named the debtor risk assessment at COFAS, which is our in-house buyer score. We have different ways. We had typically 5 ways to produce this outcome, and we've added one, which is entirely based on machine learning. We've added one. Okay, this is a very important nuance because we're not replacing easily things. We start by adding, observing, and in fact, while we were very happy of the results we had, because we were increasing accuracy of the prediction. We were also increasing productivity, because that's machines doing the job. I mean, the COVID period, this is what I was referring to yesterday, also added a very key experience in our view, because machine learning is entirely based on analyzing past events. That's supervised learning. That's what we use essentially for risk management. And the COVID was a good example of a total shift of paradigm. Overnight, it hasn't been about assessing the profitability of companies all the time, their loss of clients, their financing shortages. It has been about assessing the balance between the shutdown and the state aid supports, and that was clearly not in the model. That was very enlightening in a sense, and Marty said something about it, that the human element remains absolutely vital and will remain vital for all the moments where the environment is changing, and the learning that the machine has been able to do at a certain point in time may be not valid in the future. And I think that the future will be in the clever combination of what can the machine bring, and the rest that has to remain absolutely in the hands of human analysts. And I would include in that all the relationship with our clients, because good underwriting is twofold. It's one, making a good decision, and two, being able to discuss the decision with someone that is our client.
Yeah, thank you. So yeah, I thought that experience was really interesting because for the artificial intelligence needs to have a lot of data to base its decision on, but when you have a situation like COVID, it's one single event which has no precedent whatsoever. And so suddenly your very, very smart machine becomes almost useless, doesn't it? Because it's something you can't have trained it to deal with. Mind you, for us humans, it's quite difficult as well because there's no precedent for what's happening at the moment. But that's a very interesting learning from that experience. So I want to turn to you now, Jakob, because your position in the chain is a little bit one step down, or maybe one step up, I should say, or one step along. So as a reinsurance broker, you are seeing the data coming out of a lot of different insurers and export credit agencies as well. So what has been your experience of new technology to actually better process that data you see coming from various insurers and export credit agencies?
Sure. I mean, I was going to say this one step behind, but I will go with one step up. That works for me. I mean, sort of from a reinsurance perspective, I guess it's sort of a natural step from what Marty was talking about. So whereas on the credit insurance side, on the underwriting side, they look a lot on the individual buyers, where we would tend to look at it on a portfolio basis. And in my mind, there's been quite a significant change in the way reinsurers and thereby by extension reinsurance brokers are using data really since the financial crisis, I would say. So if you go back sort of before that as a little bit of a history lesson, I think exposure aggregations was always around, but I think a lot of reinsurers sort of took a more traditional sort of P&C approach and looked at triangles and chain ladder sort of analysis. But I think one thing things like the financial crisis and arguably also COVID might have shown us is that the historical losses is not a particularly good predictor of future losses. So I would say over the last 10 years, reinsurance, and I'm talking specifically about our class, has become much more data driven and data focused, and that's partly around much more granular exposure data, so information on individual obligors, but it's also around not just the name and the exposure, but also things like ratings, probabilities of defaults, and very importantly, I would say, PML and PL information. And I think some of the work that ICESA, amongst others, have done in this area is very, very important, because only with that do we start to understand what is the actual shape of a portfolio, and that allows us to use more advanced tools. So the tools that we increasingly are seeing in our class are portfolio tools that are very, very similar to what banks would use. So these are, they're sort of Monte Carlo simulation type of tools, and you basically generate loss distributions around frequency losses, around severity losses, and those are the things that those sort of more, let's call them old school methods of chain ladder analysis would not be able to pick up. I'm not suggesting one is never going to be used again, but I'm saying a combination is probably a better way of doing it. So we really generate these sort of ground up portfolio analysis and loss distributions. And once you do that, that's when you then overlay the sort of reinsurance structures on it. And that's where we then engage with partly our clients, but also reinsurers, in trying to optimize what is the best reinsurance structure for our clients' portfolios. With that in mind, and this is where we again see partly the volume and quality of data, but also the ease of extracting data, is really that we are starting to increasingly use this not just for when a reinsurance contract is renewed on an annual basis, but even sort of during the year where you might find that a client's portfolio actually changes, as they might pursue a new business line, or they might look at increasing certain, obligors or whatever. So by having access to data on an ongoing basis, that allows us to actually start spotting trends in the portfolio, which will then allow us to have much more ongoing conversations, partly with clients and partly with reinsurance, in terms of what are we trying to do from a reinsurance strategy point of view, and how are we going to try to optimize reinsurance along the way and at the next renewal, for sake of argument. And optimization is not just about how do we get it the cheapest, but it's also what is the best reinsurance for this specific client. And you mentioned export credit agencies, you mentioned large global credit insurers, or you mentioned let's talk Lloyd's syndicates. They all have quite different needs and requirements from the reinsurers. Some try to optimize reinsurance more from a capital point of view, others try to optimize it much more from a risk mitigation point of view, and again others look more about to just want to increase their capacity, and all of those things will drive different reinsurance structures.
Okay, well, thank you, Jakob. That's very, very interesting. So let's turn to Richard now. So I guess your position is interesting with ICESA, because some of the challenges in meeting these new technology challenges, you could argue that cooperation might help to make those happen better. Do you have any examples of the industry cooperating together to solve some of these challenges?
Thank you, Mike. Yes, absolutely. And the reason for existence of associations like ICESA is to solve issues for the industry that no single participant can solve by itself. So if you look at the main projects that we've got running now, which have everything to do with technology, these are projects which, no matter how large the credit insurer is, they can't do by themselves. So Jacob mentioned the LGD project, LGD as a loss given default, where you basically say, if I sign 100 of commitment today, now were it to turn into a loss, how much is that loss going to be? That is extremely important for the credit insurer's capitalization and capital models, and for the regulations that determine that. So what we have been doing, and what the LGD PML project has been doing since 2002, is calculate that on basis of the loss experience of all the major credit insurers in the world. And we there play the role of gathering data, doing the calcs, and giving that back to market. Is it high tech? No, but it is one of the major inputs of something that is really high tech, and those are the capital models of our individual members. Now, if you really start to talk high tech, one of the interesting proof of concepts that we're running right now is called, we termed it double dip. So what does it do? You get the following situation where a seller sells goods to a buyer, produces an invoice, and has credit insurance. The buyer defaults, but before the default of the buyer, the seller sold the invoice to a factor, to a forfeiter, to his banker, who also has credit insurance. Now, we are running a project of 2 major credit insurers to see whether we can identify that invoice as being claimed upon twice. Nobody wants to share data with a competitor as sensitive as, this is my insured, these are the policy conditions. So what we are doing is we're doing on the blockchain on what they call zero knowledge basis, where the deliverer of the data, so the invoice, says, I have this piece of information. I'm not going to share with you what it is, but I have it. Somebody else shared the same piece of information and leads to the same conclusion. Both get a signal, hey, listen, this invoice is claimed upon with you and with somebody else. Why don't you start looking? Now, again, this can only be done by an impartial third party, and that is ICISA in this case. Same goes for major projects, such as the one we're running with RiskStream Collaborative to put surety on the blockchain. Now, it's a large project. Everyone is talking about the blockchain. I get the feeling stronger and stronger that everyone thinks they know what the blockchain is. But if you put it at work for a specific project, such as putting surety on the blockchain so it can be shared between the obligor, the obligee, and the surety, that it becomes a very different animal, and it has to be structured very, very well. And that's what we're doing at the moment.
And so far successfully?
The POC is looking very, very good, and I see Patrice smiling there because he gets all the kudos. He is the one that, as president of ICISA, started these projects.
Yeah, of course. Patrice being until very recently president of ICISA. Yeah.
Correct.
Yeah. Okay. That's very interesting. So, if we think about use of artificial intelligence out there in the world, often you see it as in terms of Netflix and Amazon and so on. It's really more used in a customer-focused selling way. Are any of you using these techniques also in that way, as towards selling and client relationships?
We do. Maybe I can quote two examples. One of them is about assessing client satisfaction, really seen from the inside, just crunching data. And what we do for that is that we have trained a robot predicting the churn of clients on the basis, the assumption that client churn when they're unhappy. So predicting the churn is a good way to assess satisfaction or unsatisfaction. And there was a bit of research at first. We didn't really think that the results would necessarily be very convincing. And after testing it for a couple of years, actually, account managers really liked it, saying that it was a good help for them to be on the ball, on the right accounts at the right time. So we started using it more massively. So that's one example, for instance. Do I have time for one, or you?
Yes, go ahead. Yeah, it's very interesting. Go ahead.
Another one, a small thing. We've struggling with our clients saying, well, sometimes your decisions are too long. And so we were trying to be transparent about our response times. And they were arguing, well, you give us average values, and the problem with us is always the longer time frames when one credit limit request doesn't come back. And working with clients, we finally found out that the problem was not about knowing the delays. The problem was about knowing how long it would take for this request, because they had to have something to say to their sales colleagues or whoever internally. So we put the case with our data scientists and said, would you be able to predict how long it will take us to reply to this very credit limit request? And they've done it. So we've got now in our online system, Cofanet, we've got this prediction, like if you're in the underground and on the platform, you've got a sign saying the tube will be here in 2 minutes, in 1 minute. We've got something like that now running. So it's a small thing, but it really helps reducing the pain and the efforts of clients. So that's the surface of things, but for us, it's a very valuable use also of data science.
So maybe you'll be getting to the stage at one time where you will be able to know that the client wants to apply for a particular credit limit before they know themselves, and prepare it ready for them.
We haven't tried it.
That will be great.
Maybe we should.
Okay, so thinking about connectivity now. So Jakob, you get all this data from your clients, and you put it through your credit tool, and then you process it and model it, and it goes to the reinsurers. Now, do you have any direct connection with your clients? I mean, are there any APIs? How does that data come to you? Can you see into the systems of your clients?
I can't, and I'm not entirely sure they would want me to either, in fairness. so data typically is actually delivered pretty much the same way it's been delivered for the last 10 or 15 years. It's delivered through Excel files and similar to that. You know, and equally, you know, there's no real direct link between what we produce and what goes to reinsurers, other than, as I say, through files. The only area where reinsurers actually have access to some of our systems is that everything we place is placed through something called Guy Carpenter Marketplace, which is where eventually reinsurance is placed through, and reinsurers do log into that system and confirm the terms and the written line and so on and so forth. But the link between us and our clients is all through exchange of files that is typically either via emails and upload to FTP servers and that sort of stuff. We've had some discussions because increasingly, you know, as I said, reinsurers and us as a broker, there are similarities to the tools we use. So there has been some discussions among us and a few reinsurers whether, on the basis that we load our tool, whether in fact the reinsurers could receive that after we had loaded it, because that would save them from having to load their tool, if you like. But I think it's also important to note that, you know, we're not rekeying things really. It's more a matter of getting, you know, receiving data in a certain format such that it's easily uploadable, if that's the right way of putting it.
Okay. So if we imagine the total chain between the customer and the investor who provides the capital, I guess we've got 4 intermediaries in the chain. So we have the customer, and then we have the primary broker, then we have another intermediary being the insurer, then we have another intermediary being the reinsurance broker, and then we have another intermediary being the reinsurer, and then there's the investor who provides the reinsurer with the capital. So could any of you see any scope that you could have the same data shared across those 4 intermediaries between the customer and right to the back? Marty, could you see that happening?
Well, probably a little bit of water will flow through the Rhine before that happens, but I could already see quite a bit of connectivity, of course, between our customers and also our information sources and all other public sources for information that we actually are directly connected with. We are directly connected with our customers, and not just via our electronic, via our customer portal, but really through APIs. Very easy way of connecting. So technology has greatly improved there, and it's much easier.
So now you just need to do an API to Jakob as the next step. And send it straight through.
It's as simple as that.
Well be.
I mean, there is clearly, you know, you can see some logic to it, I guess. But I think at the end of the day, because I think one thing which is important is that I think we're all using the same data, and the source. There's only really one source for each sort of piece of the data, if that makes sense. But I think the use of the data is quite different.
Yeah.
Right.
Yeah. Totally agree there. I think that the data might be the same, but the data that a broker, a primary insurance broker uses will do different things with the data that we will do maybe on individual assessments or customer indeed satisfaction, likelihood of leaving or likelihood of buying. Well, a reinsurer wants to probably take a look at the bigger portfolio. So that's going to be a different use, but yeah, in the end, the data is all the same. And I think by having good agreements in place on who owns what and who does what with what, I could see that eventually happening. But it doesn't even have to be rekeying. It may not be one pipeline, but it could be various pipelines between the various entities. I mean, I can imagine that customers are already having some a pipeline with their primary broker, which then they packaged in a certain way through a next pipeline, and it comes our way, and like that. Because everyone needs to be exceptionally efficient. Data is massive, so you can't just, I mean, when I started, we had one file with a few credit agency reports, for instance. Well, if you now see the amount of information and data that is being thrown at every individual in the world, you can't, it's humanly impossible to all digest that. So we also need, for that reason, the machines. But why not? I mean, we're all in the end there to service our customers, including with the help of our reinsurance and all the brokers. So if that makes for a better world, why not?
So what do you think are the challenges in terms of just connecting everybody in the chain up in that way and sharing the same
Mike,
data?
before you do, I think there's one really important dimension that tends to be forgotten when you talk about sharing data, and that's aggregation level. Now, if I look at the whole chain from insurer through primary broker all the way to the investor in the reinsurer, the aggregation level of data is vastly different because they do different things with it. Now, with that aggregation level also comes a certain amount of anonymity, which soothes the concerns that people have about the privacy of data. So when we talk about sharing data, yes, absolutely, but at what aggregation level?
Yeah, and I guess the key concerns are control and trust, I think, in doing that, and that's quite challenging, isn't it? So I think it's quite interesting as well that you see some of the brokers kind of setting up portals to their clients and then portals to the underwriting market. And if we imagine that you know, the oil is the new data, as somebody, sorry, the data is the new oil. Sorry, I said it backwards. The data is the new oil, as somebody said earlier. Have you got any views on which of the parties in the chain is likely to have the best control of the data? Will it be the primary broker, the insurer, the reinsurer, the reinsurance broker? Do you think any of them will kind of get a dominant role there, or how is that going to work? What do you think?
Maybe I can start on this one. I'd say that the size will matter in that respect. I mean, the largest you are, the greater is your capacity to reach statistical volumes or statistically relevant volumes. That being said, I think that supposedly tomorrow everyone has portals, can capture and organize data. I think that probably, I would imagine that brokers would be very good on relationship data, knowing the clients very well, the client interaction very well. I would imagine that we insurers will remain more probably deep and knowledgeable on the risk underwriting data, all that is turned towards the buyers, the statistical steering all the portfolios, etc. I would imagine that this will stay primarily with us. So what I see, looking back maybe to what Marty was saying, is that a series of flows where maybe you would have certain profile in the industry, maybe the broker capturing certain data, then sharing them, but not necessarily someone being totally dominant in the sense that they own all the data and serve all the others. But that's a personal view, I guess.
A view to which I subscribe, by the way.
Yeah.
Because it everyone has a different role to play, and the roles may change, and data may bring some changes to the roles. But I don't think that it's going to be one dominant party in the market who will own everything and basically push every other one in the chain totally aside.
Yeah, and that again comes back to the trust and the control, doesn't it? You know, if we're going to connect automatic with APIs, the parties in the chain, there's got to be trust and control that nobody's going to be pushed out, otherwise it won't happen. So, a final question for you. We started off with this magical way that NCM invented the internet 30 years ago. At least that's the way I remember it. What obstacles do you see to the credit insurance staying at that absolute cutting edge as it was then? What are the obstacles to prevent us, and what can we do to make sure that we collectively do stay at the front edge?
Well, if I can start this one. The obstacle and the solution are basically one thing. Now, I'm on record as saying we're all a little bit too old, we're all a little bit too staid. We know exactly what's happening within trade credit insurance, but are we really digital natives? Are we on top of the technology which we are able to use? And the question there is, at the working level, yeah, probably, because we've been working on this. And that's a good thing, because one of my past employers did a survey once, how attractive is the insurance industry as an employer? And it came just after going to war, which I think is a pretty low barrier to cross. But it also said, look, it's got to be enriching, it's got to be good to society. And I think we're doing a reasonable job. Now, if you move up the hierarchy, I don't think it's hit there yet. It hasn't hit home. So do people know what's possible? Are people willing to invest money in staying on top of our game? That is the big challenge for me.
Yeah, interesting. Any other thoughts?
Yeah, I would like to challenge here a little bit, because I think that certainly our company, but also for sure COFAS and others are investing heavily. You know, it's all often, as always, it's a lot about money. You know, how much money can and will you spend on it? And yeah, maybe about the ones in the hierarchy not being the digital wizard kids that currently are basically are in university or have just left. True, I'm not either, but I think we will be able to actually give the playing field at which those great whiz kids can actually do their thing, but always in the framework of being relevant to what we do. As a company, we might do a bit of exploratory inventions, but so I think that it's again a combination of, you know, the gray-haired people that know a bit about credit insurance and the ones that come new technology, and an open mind helps there a lot, I think.
Yeah. So I must say I'm very impressed with some of the digital natives surrounding me in Schumann. And one of them is going to speak later, Nicholas, if you tune into his presentation. But I find that really inspiring, actually, and you can see completely fresh ways of thinking. And we have to let these people have the power in the industry, really, I think, as Richard says, to so that we're again like NCM in 30 years ago. Okay, well, thank you all very much for your contributions. That's been really, really interesting. So, Robert.
Yeah, fantastic. So thank you very much for your moderation. Thank you very much for joining this panel. That was really fantastic to share with you views and the insights into your business.